When most people talk about wealth building, they immediately jump to the exciting stuff, stocks and high growth.
Right.
But any diversified strategic portfolio has to have a backbone, and that backbone is often bonds. The sources treat this fixed income asset class as foundational. That's right. A bond is essentially a loan. You, the investor, are giving a loan to an entity, a government, or a corporation. In return, they promise to pay you a fixed interest payment over a set term and then give you your principal back at the end.
It's crucial for capital preservation and generating consistent income, and it's typically less volatile than stocks.
Exactly.
So what does the long-term performance data tell us about bonds?
Our sources, drawing from research by firms like S&P Global and Dimensional, they confirm that long-term bonds, on average, earn higher returns than short-term bonds. But it's not just about duration. It's about understanding the factors that are linked to expected returns, like credit risk, liquidity, and term risk.
So while a longer duration might yield more, it also exposes you to greater interest rate sensitivity.
Precisely. That's the trade-off.
So if a listener is evaluating a bond fund, what should they be looking for beyond just the headline yield?
They have to focus on key risk-return metrics. You need to look at the duration of the fund, that's its price sensitivity to interest rate changes, and the credit quality of the bonds inside it.
Yeah.
And a really vital topic right now is the role of ESG, environmental, social, and governance factors.
How does that affect bonds?
Well, the data shows that the ESG profile affects bond return volatility. High ESG ratings often correlate with stability and a lower risk of default, even if the initial yield is a little bit lower.
We often debate active versus passive investing for stocks. Is that debate also happening in the bond market?
It is, but with different results. Morningstar analysis shows that the success rates of active versus passive bond funds shift over time. In really efficient markets or when rates are stable, passive index funds often win out because of their lower fees.
But when things get choppy.
Right. When interest rates are volatile or credit markets are stressed, a good active bond manager can often capitalize on mispricing and credit research, and they can generate alpha that a passive fund just can't capture.
And for anyone wanting to do their own due diligence, where can they find reliable, real-time info?
FINRA provides a crucial public resource, their fixed income data platform. It offers real-time bond facts, pricing, and essential educational info. It's a key, unbiased source.
Okay, shifting from the foundational world of bonds to some high-stakes speculation, we have a source focusing on one of the most bullish predictions out there. Tom Lee's forecast for the S&P 500. This is the kind of call that investors either build entire strategies around or
They vehemently dismiss it.
Exactly.
Lee's outlook is undeniably ambitious. It suggests historic growth is on the horizon. He's predicting the S&P 500 could reach 7,000 or more by mid-2025.